Some investors are saying that the old investing epoch has come to an end. You can read all about this in today's morning brief over at the Yahoo Finance homepage. For more, let's bring in Yahoo Finance's Jared Blikre. Jared.
Great moderation. Afraid to tell everybody that it is over and a new regime is in place. First, I just want to map out the historical context of U.S. GDP, and this goes all the way back to World War II, so basically the mid-40s. And you can see it was very volatile over this period of many decades into the early 1980s. Now, what happened in the early 1980s? Over the 1970s, we had that huge bout of inflation, and Paul Volcker over at the Federal Reserve finally tamped down inflation in the early 80s. So that was the beginning of a huge bull market and also a huge peak in interest rates. Interest rates have trended down for roughly 40 years, except recently they've picked up, and we'll get to a chart of that in a second. But this relatively lower volatility area, which we call the Great Moderation, and which historically encapsulates the time from the mid-80s all the way up to the global financial crisis. You can see it actually extends quite nicely beyond the global financial crisis, and this all has to do with interest rates. Now remember, the interest rates had peaked in the early 80s and they were coming all the way down, and in response to all of this, we had Greenspan at the Federal Reserve, we had Bernanke in the early 2000s, then we had Yellen, and then we got Powell. Now, Powell has presided over the pandemic. That's prevented companies from exploring their own supply chains, and we're going to get into that in a second. But let's get to some charts here. First of all, I want to show the 10-year T-note yield. Now, this goes back all the way to the late 1980s. And in fact, this number here would actually be a 15 had we gone all the way back to the top there. But you can see we have now broken to the upside. And this is what everybody is talking about here. All of this interest rate volatility with these surging rates here has dampened the desire for leverage. And as a result, risk markets have suffered. So you put all this into context, the Great Moderation probably over. This was predicated on deglobalization. That is reversing right now. Lower interest rates, lower energy costs, lower input costs, lower labor costs, all of that out the window. And in the meantime, what are we going to do about this? Well, we got some news recently over the last month, these hot CPI reports, these hot payroll reports. Probably the Federal Reserve is going to have to get a little bit more hawkish, and the market has yet to adjust to that. So some potential near-term pain, but investors going forward can look forward to higher interest rates. You take a look at what the 13-week T-bill yield is right now, 4.73% for investing over 13 weeks. We haven't seen that since about 2007 in there. So overall, good for some savers, good for the fact that fundamentals will matter once again. In the meantime, though, we got to figure out what we're going to do about this inflation.
Yeah. Higher rates, higher inflation, higher volatility.
Yep.
Sounds like that's what we're in for.
That's
Thanks,
the cycle.
Jared.